Ajay Srivastava, MD of Dimensions Consulting, joining us on the show. Ajay, great to speak with you as always.
Good morning.
Good morning. So, what do you think is going on? December mood has set into the market. Everyone in holiday mood, or a little worried about what's happening next?
Worry? Do you think anybody's worried? I can't believe anybody's worried in this market
You never
because
look worried, so.
oh my God. You know, with God's grace, and I think what's happened to all of us, I think the equity investors had a good deal in the last 2 years. This year has been exceptionally well, of course, and therefore, one should take the glass half full and says, we made a lot of money, let's go enjoy ourselves. And rather than worry about what's going to happen next year, I'll tell you what going to happen next year. US is going to do extremely well. It'll take the world economy up. We will have our own set of problems. But as always, economy is different, market is different. So if you're a stock market investor, I don't think you need to worry anything about next year. The what changes we are seeing in our economy makes our stock market a little more impervious from what's happening in the general economy. So yes, growth is down, but your portfolio will do well because why will portfolio do well? Because you are investing in the companies which are changing the market structure today. So it doesn't matter economy can grow 5%, your companies are going to grow 40%.
That will be an interesting set. But yeah, Ajay makes this telling point. Viewers, in case you didn't know, the S&P 500 is on track to outperform global stocks for the 14th year out of the last 15. This is the longest streak in 75 years and would tell you why it shouldn't surprise you that global money wants to be in the US because that market is doing so bloody well. So no harm in being there. Ajay, I heard you say that the US may do well, but our markets also may do well even if the GDP doesn't. And your portfolio could grow 40% because you're investing in new age companies. Now, not everybody is doing that. So we'd love to understand from you, how are you building a portfolio which is dominated by new age companies, Ajay?
See, without recommending any company, let's take a very simple example, right? The quick service company which are coming into whatever you want to call them, whichever way, including home catering, right? What are they doing? They're replacing your kirana market. Now, kiranas are hundreds and millions of people who operate small shops everywhere. Now, as they get replaced, there are millions of people who will drop out from the consumption line who were earning a decent living but now need to go back to the dole or whatever. But the companies who are consolidating this whole move, they are going to make tons of money. And if you're an investor in those companies, you gain a lot. So, the same market structure change of consolidation of quick deliveries into your homes, which will unfortunately, hurt millions of people who run kirana stores and therefore can impact the economy. On the other hand, it does the reverse impact on your portfolio. You're going to make money because the company which are doing this work are going to make serious amount of money. So, so the same thing, which is going to be bad for millions of kirana is going to be very good for some of the companies. And if you're invested in those companies, you got to be making dividends out of it. The second point is these companies are well capitalized. That's a more important point. That, they got capital, their ability to bring in more capital, they're growing, they're new ideas. Therefore, you are seeing an exponential growth rate, not only in terms of the business volume, but in terms of acceptance mainline. You've seen how Bitcoin has come up to 100,000. It took a long while for Amazon is hitting new highs globally. It was in the dumps for a long time. Same is happening to our companies. Hardly anybody is invested in the company worried about the losses, new age, don't understand this enough, and so on and so forth. Gradually, you're accepting it. People are saying, yeah, I think we need to get away from cement and steel and all those old foggy companies and dodgy companies and say, go on to the new age. So I think, so therefore, if your portfolio is geared toward newer companies, newer age, companies raising serious capital, new IPOs, you would do a much better than general market. Nifty 50 by and large is fuddy-duddy at this point of concern. If you're focused there, I think you're in the wrong place in the market.
I'm just wondering right now, Ajay, are you finding any interesting opportunities considering that the economic outlook also is a bit of a downer? So you see what happened with the GCPL yesterday, HUL, etc. Any of these consumption spaces that you would touch right now?
Not at all. For been 3 years, I've touched a consumer stock. I will not touch them. I told you, fuddy duddy, it's an old age. You don't go back to Fiat, right? Do you want to own a Fiat? No, you don't want to own a Fiat. You want an electric car at this point of time. That's why I said very clearly, economy will do its own thing. It's got a problem. Economy's got a serious problem. And, there's no mystery why it doesn't matter which political party, has to give doles or helicopter money to get the votes because A lot of this developments is passing by millions of people at the end of the day. They're not invested in the market. And if you're not invested in the market and you don't own gold and you don't own real estate, I think you're in a terrible place thanks to inflation. So therefore, by nature, without passing, what's equity, not equity, but the reality is that if you're owning equity, if you're owning gold, if you're owning real estate, you're on the winning side of the market. So don't worry about the economy will not do well. Capital expenditure, the biggest theme for 48 last 4 years, is gone. Government's growth of capital expenditure cannot be more than 5-10%. So what was growing 40% 2 years back is going to grow 10%. So if you're still in the infrastructure stocks, your returns may come, but it will be much, much lower because government cannot keep spending the money. And the money which is required to give, you got new elections coming up in UP, etc. By the time the toll of this 2,500 rupees per person goes out, I don't know how much will be left to spend on development. So our worry always been this fiscal profligacy of giving out doles is going to haunt us one day. Now, it may not haunt the equity investors, but certainly going to haunt the economy.
Then okay, you're not touching consumption with a barge pole. You're saying upgrade from the fiat. So then Zomato, Swiggy, Nykaa, PB Fintech, is this the new age cars? What is Ajay Srivastava buying right now?
If you don't own it, you got to be living under a bunker somewhere at this point of time. I'm not recommending you go buy it today. Please, I can't recommend. But if you don't own these companies, where have you been living, my friend? Are you in a bunker with the Second World War? The point is again the same point that if the economy grows by 5% or 6% or whereabouts, how much can a cement industry grow? How much can a steel grow? If government's capex budget cannot grow more than 10%, companies downstream cannot grow more than 15-20%. But companies reordering the market structure, newer age companies, the new engineering companies coming on board. It's amazing. I tell you something. I've never seen a more vibrant equity market than the last 12 months. So many new themes coming up. Today, what? Today or tomorrow, we are opening an issue called Indian Gemological. I'm not recommending it again, which is called rating of diamond. When did you think of these companies coming? Koreans, they are minting money out of this country, man. It's horrible to see them taking money out, but that's the reality of the market. They've 18,000 crores Hyundai, 15,000 crore LG Electronics. And so many new names and themes. I tell you something, if you're still in the old companies, get out, my friend. The world out there is beautiful.
Ajay, so one last question from my end. Are you that portfolio is completely dominated percentage-wise and number-wise by the new age space, or are there some other sectors, let's say chemicals, let's say pharma, etc., which might also be there?
Okay. No, there is one largest sector which we have, hospitals. We have a fairly large investment in hospitals. We have added up in this year significantly. And again, the same theme that at the end of the day, as wealth goes up, as population ages, you need to go for your health services. Now, government is not spending enough on the health. We all know that. You saw the budget numbers. There's not enough hospitals for people there. And if you try to get a bed in the hospital, any of you, unfortunately, you'll realize how much shortage there is in the market. So yes, I call it hospital the new age because that's the way they run these companies. They're running for utilization. I hate to use the word, but they do run it to make money for investors. Now, patients may hate it because you may do 4 procedures instead of 2. But the fact is, for investors, it's good time. So hospital is the biggest sector that we are in among quote unquote old age. But primarily, the question is everything that we've got, 80% of the portfolio we've got and recommend at this point of time is companies which have been in the market less than 3 years.
Wow. That's a telling statistic.
Yeah.
80% of the portfolio in companies which have been listed for less than 3 years. That takes away a lot of the listed space.
So what is the next big listing that you're looking forward to, Ajay? Or are you not looking at these listings at all?
It's insane season. One listing is happening just now for life sciences company. It's crazy listing. I can't even understand how anybody's paying, but well, people are paying for it, so it's okay. So listing, again, back to the point that, you need to be opportunistic about listing. We just had a new age company listing literally at the issue price and then flew next 4 days, it flew 20%. So it gives you chance to get in. But you got to be careful where you're buying in. If you're buying in on an old business, guised in a new model, that's the bad place. CDMO, it's okay, but nothing very great about it. It's not going to give you exponential growth or any kind. So even in listing companies, you got to be careful what you're doing, and you will not do a new themes. Like, well, company I just mentioned, I don't know enough about it, so please, I've not done research. But prima facie, when the guy told me that this is the company doing, demonological certification, it's a new company. You don't have a competition. It's kind of some stuff which new things do. So perhaps something like this is good in a portfolio. So, you have to choose your listing. That the company are new in a true sense of the word, not old age guys as a new company. And I think, remember the old logic that everybody put .com once upon a time, everybody putting AI right now. So you got to be careful of that.
Yeah.
As long as you're careful, you're fine.
Okay, so ditch the fiat, come out of your bunker, and don't be worried. Three lessons from Ajay Srivastava that you should not miss at the end of this very exciting conversation. Thank you so much, Ajay.
Thank you very much.
Always fun speaking with you, Ajay Srivastava.